Usually when you're sitting in traffic, right, and you see this massive yellow excavator parked on the side of the highway.
Oh, yeah, the classic construction delay.
Exactly. You just think about road work, you think about dust, finding a detour, maybe being late for work.
Right.
But if you really look at that machine, really look at it, you aren't just looking at steel and hydraulics. You are looking at a real-time thermometer.
That is a highly accurate way to frame it, actually.
Yeah.
Yeah, that piece of equipment is essentially a calibrated instrument. The pace at which it rolls off the assembly line, the price someone is actually willing to pay for it, and the lot where it ends up, all of that measures the exact heat of the global economy.
Exactly. And that brings us to today's deep dive. So today is Thursday, April 30th, 2026, and we are looking straight past the dry spreadsheets of Caterpillar Inc.'s Q1 2026 financial review.
Right, the earnings release that just dropped this morning.
Yeah, fresh off the press. Okay, let's unpack this. Our mission today isn't just to talk about tractors. We are decoding what this global industrial bellwether is actually telling you about the state of global infrastructure.
And the shifting reality of energy demand, too.
Yes, and those hidden economic headwinds that are actively reshaping heavy industry right now.
And there is just a tremendous amount of signal to decode from this morning's noise.
Yeah.
I mean, on the surface, the top-line numbers look like an absolute unadulterated economic boom.
Oh, totally.
But beneath the surface of this report, we are seeing this really fascinating tug of war. We have unprecedented, almost historical demand pulling the company forward,
Right.
while at the same time, severe multi-billion-dollar supply-side costs are acting as a massive drag coefficient, just pulling in the exact opposite direction.
It is a wild ride of a financial document, honestly. Let's start with that top-line boom, because the Q1 numbers they posted are, frankly, staggering.
They really are.
We are looking at sales and revenues hitting $17.4 billion for the first quarter of 2026. And to ground that in reality for you, that is a 22% increase over the $14.2 billion they did in Q1 of last year.
Which is, frankly, a massive jump for a company operating at this physical scale.
Yeah, we aren't talking about software here.
Exactly. Heavy manufacturing requires steel, shipping containers, thousands of localized labor forces. It does not typically scale like a nimble tech company, yet here we are looking at 22% top-line growth in a single quarter.
And that growth flowed straight down to the bottom line, too. Operating profit jumped 20% to $3.1 billion.
Incredible numbers.
Profit per share hit $5.47, which is a 30% increase year over year. Caterpillar CEO Joe Creed attributed all of this to, quote, resilient end markets and disciplined execution.
Well, the execution is certainly there.
But honestly, the revenue isn't what caught my attention. It was the backlog.
Ah, yes, the backlog.
They reported a backlog of $63 billion. That is up 79% year over year.
The backlog is probably the most complex signal in this entire earnings release.
Right, because I really have to push back on how they are framing this. I mean, a $63 billion backlog is effectively an entire year's worth of revenue just sitting in a queue.
It's massive.
Yeah, so like an analogy would be a restaurant with an exclusive wait list around the block. A 79% jump in unfulfilled orders sounds less like a victory lap and more like a massive operational bottleneck.
It's a fair point.
So does a wait list that huge mean they are thriving, or does it mean the global supply chain is so fractured that they simply cannot build the machines fast enough to keep up with the real world?
Well, if we connect this to the bigger picture, that is the exact right question to ask. A rapidly growing backlog in heavy manufacturing is often a red flag for severe supply chain paralysis.
Exactly what I was thinking.
But to understand what is actually happening at Caterpillar right now, we have to look at the mechanics of how they achieved that $3.166 billion jump in revenue this quarter.
Okay, lay it out for us.
The growth wasn't an accident. It was driven primarily by two very specific levers. First, higher sales volume accounted for $2.3 billion of that increase.
Okay, so just moving more units.
Yes. And second, favorable price realization brought in $426 million.
So let's look at the mechanics of those two levers. What does that combination actually tell us about the broader economy?
It tells us they aren't just taking orders and letting them gather dust on a desk somewhere.
Right.
The $2.3 billion volume increase means they are successfully building and shipping significantly more machines than they were at this time last year.
They're getting the iron out the factory doors.
They're pushing iron. But the favorable price realization is the crucial metric for you to pay attention to.
The $426 million.
Right. That means they raised the prices on those machines, and their customers just didn't blink.
So they have the pricing power to demand more money, and the market is just completely absorbing it.
Precisely. It signals incredibly inelastic demand. Contractors and mining companies need this equipment so badly that they're willing to pay a premium and wait in line to get it.
Wow.
So while they might not be building the machines quite as fast as the orders are rolling in, they are absolutely executing on the production line and converting that massive backlog into cash at a premium rate.
Here's where it gets really interesting, though, because to understand why buyers are suddenly willing to pay a premium and wait in line, we need to look under the hood at what they're actually buying.
Right, the segment breakdown.
Caterpillar divides its business into a few main segments. Let's look at the power and energy segment. Sales there hit $7.03 billion, which is up 22%.
A huge driver for them.
Yeah, and segment profit hit $1.45 billion.
And the driving force behind that energy demand is likely not what most people would assume.
What do you mean?
Well, yes, oil and gas compression is a significant factor. That's traditional Caterpillar. But the real structural shift happening in the power and energy division right now is power generation.
Oh.
Specifically, the sales of turbines and large reciprocating engines.
And who is buying massive reciprocating engines? Data centers.
Exactly.
We constantly associate Caterpillar with moving dirt, but they are increasingly becoming the physical backbone powering the digital cloud.
It is a brilliant example of how industrial Rust Belt manufacturing is inextricably linked to the modern digital economy. The exponential growth in data centers driven by cloud computing, streaming, massive AI training models, all of that requires an absolute, non-negotiable guarantee of continuous power.
Because the local power grids in places like, Virginia or Texas are already incredibly strained.
Highly strained.
A data center cannot afford a brownout that lasts even a few milliseconds, or it corrupts massive amounts of processing.
Exactly. So these data centers aren't just buying small backup generators like you'd have at a house.
Right.
They're buying equipment that essentially acts as a localized parallel power grid. A large reciprocating engine is basically a locomotive engine bolted to the floor of a server farm.
That is wild to picture.
It is. Running on natural gas or diesel, just ready to take over the massive baseload the second the main grid falters, Caterpillar is perfectly positioned to capitalize on this tech boom.
So they are riding the AI wave just as much as the silicon chip manufacturers are, really.
Absolutely.
But let's pivot to the segment that saw the biggest absolute growth: construction industries. Sales there hit $7.16 billion, which is a 38% increase.
A very strong quarter there.
And if you look just at North America, sales jumped an incredible 48%.
That is a staggering regional growth figure for heavy construction.
It is, but the earnings report notes a major caveat. This 48% jump was heavily driven by changes in dealer inventories.
Yes, that's a crucial detail.
The independent local dealerships who actually sell to the end users are aggressively restocking their lots right now. In Q1 of last year, those same dealers were slightly decreasing their inventory. So my question is, if dealers are just restocking their lots, is this localized restocking a sign of actual demand from people building roads and houses, or is it just perceived future demand?
This raises an important question about the mechanics of the supply chain. You're touching on a critical vulnerability known as the bullwhip effect.
Okay, the bullwhip effect. Walk us through that.
There is a massive difference between end-user demand and dealer inventory padding. End-user demand is the contractor in Ohio walking in and buying an excavator today because they won a local highway contract.
Right. Real money changing hands for a real job.
Exactly. Dealer inventory padding is that same dealership in Ohio ordering 10 excavators from the factory because they expect a busy summer.
And right now, we are seeing a massive wave of dealerships padding those lots. They're looking at local infrastructure spending, housing needs, and they're just stocking up.
They are intensely confident right now, but the bullwhip effect is dangerous because it distorts reality for the manufacturer. Well, let's say interest rates tick up, and end-user demand in Ohio softens by just 5%. That local contractor delays their purchase.
Okay.
The dealer, who is suddenly holding millions of dollars in unsold inventory, doesn't just reduce their next factory order by 5%. They freeze their entire order to avoid the carrying costs.
Oh, wow. So a tiny drop in actual construction activity at the local level snaps back like a bullwhip and hits Caterpillar's factory with a massive, exaggerated drop in orders.
Precisely. So while power and energy and construction look like they are booming on paper right now, That aggressive dealer stocking behavior creates a precarious overhang.
It's a risk.
Yes. If the market cools even slightly, those factory orders will evaporate overnight. And we already see how quickly things can turn when we look at Caterpillar's third major segment.
Right. We need to talk about the resource industry segment. This is the elephant in the room. This division handles the absolute heaviest equipment, mining machinery, rail, heavy, earth-moving.
The real giants.
And compared to the double-digit growth in the rest of the company, the numbers here are a shock to the system.
They provide a stark, undeniable contrast to the rest of the report.
Sales in resource industries barely moved. They were up only 4% to $3.79 billion. But the segment profit plummeted.
Yes, it did.
It dropped 39%, falling all the way down to $378 million. So mechanically, how do you sell more equipment but watch your profits just fall off a cliff?
Well, the earnings release explicitly identifies the mechanical cause. They call it unfavorable manufacturing costs. And this drag didn't just hit the mining division, it acted as a massive headwind for the entire company.
Right.
Those unfavorable costs hit Caterpillar to the tune of $710 million in the first quarter alone.
And the primary driver of those costs, higher tariffs.
Yes.
Over $700 million in a single quarter, entirely due to tariffs.
Yes. These are tariffs that were implemented since the beginning of 2025, and they are now fully baking into the global supply chain.
And just to be clear for everyone listening, we are looking purely at the financial math as reported in the company's filings here. We are completely independent of the politics behind international trade policy.
Absolutely. We are just looking at the ledger. And mathematically, a tariff is not just a tax on a finished tractor, it compounds.
What do you mean by it compound?
It is a tax on the raw steel, the specialized microchips, the imported rubber for the treads. It hits every step of the assembly.
And the math going forward is severe. The report lays out their expectations, and they project Q2 2026 tariff costs to be around $700 million.
It doesn't let up.
No. And for the full year of 2026, they are projecting a tariff hit in the range of $2.2 billion to $2.4 billion.
Over $2 billion effectively vaporized from their operating profit.
So what does this all mean? If they are getting hit with over $2 billion in expected tariffs this year, how do you take a $2.4 billion punch to the gut and still tell your investors that you expect low double-digit revenue growth for the full year?
It seems contradictory.
Yeah. How does a company actively losing billions in geopolitical friction afford to keep its doors open, let alone expand?
What's fascinating here is how management uses their profit margin targets to explain exactly how they absorb that blow. They maintain a targeted range for their adjusted operating profit margin.
Okay.
They clearly communicated to investors that, including the impact of these multi-billion-dollar tariffs, their 2026 margin will sit near the bottom of their target range.
So they are still hitting their profitability targets, just barely scraping the floor of what they promised.
Correct. But they added a crucial piece of context. They explicitly noted that if you were to exclude the impact of those tariffs, they would be operating in the top half of their target range.
Oh, that isolates the variable perfectly.
It does. It demonstrates to the market that the core mechanics of their business, their engineering, their sales volume, their pricing power, are running so efficiently that they would be putting up top-tier margins.
But reality gets in the way.
Right. The realities of the current global trade map act as a massive drag coefficient. They're essentially telling Wall Street, we're operating at peak efficiency, but navigating international borders is costing us $2.5 billion.
It is the ultimate collision of microeconomic execution and macroeconomic forces.
Well said.
And that brings us to the cash flow, because you would think a multi-billion-dollar hit to the margins would make a company retreat, right?
You would assume they'd tighten their belts.
Exactly. But when you look at how Caterpillar is deploying its capital, it screams extreme confidence.
They're certainly not adopting a defensive posture.
Not at all. Let's look at the machinery, power, and energy segment. Their operating cash flow was $1.3 billion, which is up 41%.
Significant cash generation.
But the real aggression lies in what they did with that cash in Q1. They deployed $5.7 billion back to shareholders in just 3 months.
In a single quarter.
Yeah, that includes $700 million in dividends and $5.0 billion in share repurchases. And the bulk of that was a massive $4.5 billion accelerated share repurchase, or ASR.
Now, we all know the mechanics of an ASR. You hand an investment bank a mountain of cash to retire a massive block of shares instantly, rather than buying them back slowly on the open market.
Right.
But executing an ASR of that magnitude right now is a massive flex of corporate leverage.
That is exactly what I was thinking. Deploying a $4.5 billion ASR is aggressive on a good day. But doing it when you are staring down a $2.4 billion tariff bill for the year,
It's a statement.
it's like having a variable rate mortgage, seeing a massive economic storm on the horizon, and instead of hoarding your cash, you just push all your chips to the center of the table. You aren't just weathering the storm, you're buying the casino.
That's a great way to put it. It is a deliberate signal to the market. Management is saying that their $63 billion backlog is generating so much predictable premium-priced cash flow that they can easily absorb the tariff hit and still believe their stock is deeply undervalued. But they aren't just deploying capital into financial engineering. They also updated their physical, operational growth targets for 2030.
Which loops right back to our discussion about the data centers and the energy grid.
Exactly.
They announced they now plan to increase their large reciprocating engine capacity to nearly 3 times their 2024 levels.
And remember, they had previously targeted a 2 times increase.
Right.
Expanding that target to 3 times capacity requires massive investments in physical plants, tooling, and specialized labor. They are also targeting their overall power generation sales to be greater than 3 times compared to 2024.
So they are actively building the infrastructure to support the next decade of the digital economy. If we synthesize all of this, it tells a remarkable story about scale.
It really does.
Caterpillar has so much pricing power that they can do 3 massive things simultaneously. 1, they can absorb a $2.4 billion geopolitical tariff hit. 2, they can hand almost $6 billion back to their shareholders in a single quarter.
Yeah.
And 3, they can still actively deploy capital to triple their physical manufacturing footprint for the energy sector.
It reveals how a global titan operates. They don't try to outrun the storm. They use their sheer financial mass to sail straight through it while expanding their operations.
Well, this has been an incredibly revealing look into the mechanics of heavy industry. We want to thank you for joining us on this deep dive today. We've tracked the reality of Caterpillar's first quarter of 2026 from a $63 billion backlog, testing the limits of the supply chain, to the hidden reality of diesel engines backing up the digital cloud.
And the bullwhip effect hovering over dealer lots.
Yes, and of course, the multi-billion-dollar realities of global trade friction.
But before we sign off, I do want to leave you with one final thought to ponder.
Okay, let's hear it.
We spent a lot of time breaking down the massive drag of that tariff hit.
Yeah.
But if you dig deep into the footnotes of this earnings report, there is a fascinating mechanical detail. Caterpillar actually managed to secure a 31-cent per share favorable adjustment to their tariff costs in Q1, alongside a discrete tax benefit of 15 cents per share.
Wait, a discrete tax benefit? What does that mean in this context?
Yes, a discrete tax benefit is essentially a one-off accounting event. It could mean they settled a prior year's tax audit favorably, or they realized a specific non-recurring credit.
Interesting.
It drops straight to the bottom line for this specific quarter, artificially padding the profit slightly. But it isn't repeatable operational revenue. It's pure financial navigation.
So they basically found over 45 cents per share of pure padding buried in the tax code and trade adjustments.
They did. And this raises a really important question about the future of global enterprise.
Yeah.
In today's highly volatile world where supply chains are fractured and trade policies shift overnight, what is the true competitive advantage of a 100-year-old heavy machinery giant?
Right. Is it still just building the best engine?
Exactly. Is it still rooted purely in their mechanical engineering and their ability to forge a more efficient tractor? Or does their survival and profitability now rely just as much on their army of tax accountants, supply chain specialists, and international trade lawyers navigating the loopholes of a fractured global map?
That is a phenomenal question to end on. Because the most perfectly engineered excavator on Earth is completely useless if you can't afford the tariffs to get the raw steel across a border.
Exactly.
It is an entirely different kind of engineering. Just something to think about the next time you see that yellow machine parked on the side of the highway. It is doing a lot more than just moving dirt. It is actively carrying the weight of the global economy. Thanks for listening, and we will catch you on the next deep dive.